Hi everyone in the Emerging Value Summit 2013. I'm KB from Singapore. I'm honored to be presenting to you my topic, Resilient Compounders in the Next Crisis. Buffett plus Bosch plus Bayao equals Bamboo Innovators. Talking about crisis, interestingly, this topic was decided on the 4th of March, just a few days after Oliver and myself met up in Singapore. And this is before the Cyprus deposit crisis broke out 2 weeks later on March of 17. So why Bamboo Innovators, you might ask? Bamboos bend, not break, even in the most terrifying storm or devastating earthquake that would have snapped the mighty resisting oak tree. It survives, therefore it conquers. Disruptive industry trends and black swan crisis have become a permanent fixture in today's marketplace. How wonderful it would be if countries, companies, and even individuals like us can stay resilient amidst the disruptive upheavals and unorthodox challenges, like the bamboo. This research framework and mental model of Bamboo Innovator is born out of the crisis period based on my personal journey as a value investor in the Asian capital markets over the past decade plus. Prior to the 2007 and 2008 global financial crisis, Asian fund managers who are the gunslingers in investing in stocks with sexy growth stories, riding on some industry trends, are the heroes. Excess returns of 100 to 500 percentage points in beating the index are not uncommon. Yet, post-crisis, we start to see how many of the companies that delivered these outsized returns start to unravel with accounting scandals. And there is a sizable number of companies in Asia whose balance sheet appear flush with net cash and valuations appear cheap when we run our usual quant screens based on Ben Graham's net-net principles, but in fact they are value traps whereby cheap gets cheaper and value investors run the risk of catching a falling knife as the controlling owners and managers simply expropriate the cash and assets out of the listed vehicles in a clever way to their multiple private business interests. In this next half an hour, we will learn the Accounting 101 on how they do a money grab and pull you up on a money go round trip. Thus, with over 80% of the listed universe in Asia of 15,000 stocks under $1 billion in market capitalization, and the median market capitalization is around 80 million to 100 million US dollar. 2, the stock prices and volume and liquidity in Asia are often manipulated by nefarious insiders and syndicates of momentum traders. And 3, outbreaks of accounting scandals, corporate governance lapse, and asset expropriation erupting on a systematic basis at the firm level. So how does a long-term investor go about investing in Asia to generate sustainable outsized returns? So if running quant screens to filter the 15,000 stocks in Asia don't work given the corporate governance risk, what works then? Hence, I hope this Bamboo Innovator framework will be useful to value investors when adapting the Buffett-monger evergreen value investing principles to Asia, which is full of booby traps. There are 6 parts to this presentation. In this first part, I'd like to quickly bring us around the world, from America to Europe to China, to look at Bamboo Innovators, whose personality are represented by Buffett from America, Bosch from Europe, and Bayao from China, and why these resilient compounders are especially relevant in crisis period, and what are their common characteristics, so that we can keep finding them and investing in them in a systematic way. Next, I will discuss the Bamboo Innovator framework, following which I will talk about booby traps in the Asian capital jungle and how having a bamboo in our hearts can serve as the inner compass to not get lost in this jungle in Asia, which is full of dangerous animals and poisonous creatures. And in the live seminar on April 10th of the Emerging Value Summit 2013, I'll be sharing with everyone an actionable Asian stock idea that I wish to discuss that falls under this Bamboo Innovator framework. So I'm excited to join you on April of 10. The key quality that value investors look for is resilience. in market conditions as now, with the risk of the multiple sort of the Damokles falling down, investors are often immobilized in making investment decisions. Oh, let's wait for a market dip to a certain cyclical adjusted PE level before we invest, though we should always be careful of the unresolved crisis on the horizon. Oh, let's pick those stocks with cheap valuations on a net-net basis. How much lower can they go anyway? So resilience is actually the ability to replicate and scale from scratch, and the indestructible intangibles to bounce back from crisis. One of the most profound insights that Buffett gave all of us was this. If you gave me 100 billion and said, take away the soft drink leadership of Coca-Cola, I would say that it cannot be done. This deep statement implied that it's no longer about having money or tangible assets that give a company its intrinsic value. I like to push Buffett's idea even deeper. How about burning and destroying all the tangible assets? Is such a company worth anything then in the eyes of a value investor? In the case of Germany's Bosch, that kind of company is worth over 150 billion US dollar. Robert Bosch, the founder, invented the magneto ignition device in 1887, but he didn't know what it can be used for, and it was only 10 years later, in 1897, before he had his breakthrough in applying the device to vehicle engines, an invention which took another 5 years for patent approval. And so he embarked on a regional and global expansion in the next 5 years. And during World War I, Robert Bosch lost everything. His factories and plants and all the tangible assets were all destroyed. Yet he was able to bounce back up, and his invention was applied in more applications beyond vehicle engines, from water pumps to emergency generators. And last year, in 2012, Bosch produced and sold 11 billion spark plugs. Can anyone name me a company that goes into such accounting details of keeping track the numbers by the billions? So is investing all about catching the timing of cycles? During the 07-08 crisis, as Shanghai Index plunged from 6,000 in October 2007 to below 2,000 at the bottom in March 2009 to struggling at 2003 presently, there is this stock with a market capitalization of 8.6 billion US dollar that you see at the bottom of the slide that is resilient like the bamboo. It didn't fall much as the index crashed 60%, and it has exceeded the previous 07 peak by nearly 200%. So this company is called Yunnan Baiyao. Yunnan Baiyao is a drug invented by a herb collector called Qu Huanzang. And this drug carries the seemingly contradictory effects of helping blood to clot and promoting blood circulation through the body. During the Vietnam War, American soldiers found Viet Cong soldiers survived gunshot wounds when they ate the Baiyao pills. Qu discovered the herb when he observed how animals who suffered terrible wounds and cuts would go into this certain herb bush, and when they emerge after staying in the bush, they appear much better. And this Baiyao pill is so potent that the course of China's history would change. If Qu had given the recipe to the Kuomintang party leaders when they were fighting against Mao's CCP, the Chinese Communist Party, Qu would rather die than divulge the secret recipe, and he was brutally murdered as a result. The secrecy surrounding the Baiyao drug and its ingredients carries a similar mystique to the Coca-Cola formula, and Qi's wife generously donated the secret recipe to Mao's government in 1956. Baiyao survived the death of its founder and the turbulence of the Civil War. It is indestructible because of the intangible know-how in hemostasis that helped Baiyao, the company, to scale from drugs to pain relief aerosols to even toothpaste. The Baiyao toothpaste is supposed to help to prevent gum bleeding, which is common amongst the Chinese elderly and even working adults. From a mere 3 billion renminbi in accumulated sales during the first 2 years of its launch in 2005, sales of the toothpaste now exceed renminbi 1.6 billion. Many experts who caught Baiyao stupid were dumbfounded by its success, especially when the toothpaste is selling at renminbi $20 a tube, which is 5 to 10 times more expensive than its peers then. So who would be out of their mind to buy a $20 toothpaste? Isn't it? And there's pricing power that Buffett looks for. Each tube is now renminbi $28 from $20 when it was launched. Baiyao now has $8 billion brand products developed from its intangible know-how in hemostasis. It also has an open innovation business model whereby MNCs from Germany's Basedow to America's 3M partner with Baiyao to co-develop new products, all because they were attracted by the intangible know-how in hemostasis at Baiyao. As Munger puts it aptly, we need a mental model to help us navigate a world where we are bombarded by information, or too much information in fact. Buffett, Bosch, and Baiyao have shown us that value investors can overcome poor and uncertain macro conditions to be resilient compounders because they have their own internal rhythm to create value, like the bamboo. Yet interestingly, a good to great checklist will often overlook these bamboo innovators. After all, they are much larger, impressive trees in the forest. By comparison, a bamboo looks smaller, thinner, and fragile. The list of bamboo innovators is a surprising one. Many of them are not the typical ones that one would come across. There are three distinct characteristics in both a bamboo and a bamboo innovators from my research and personal observations over the past decade plus. I call it the RES framework. R stands for rootedness in a culture of kindness, trust and cooperation to foster innovations. E stands for emptiness in the business model. And most people might be shocked to know that the bamboo have an empty hollow center. Yet it is this very emptiness that gives the bamboo its resilience, as I will discuss very shortly. S stands for chef leadership to protect emerging ideas, much as how a bamboo chef serves to protect the bamboo shoot from harm. I'll be elaborating on the emptiness criteria due to time considerations. As a side, the bamboo is so useful and unique that we even have an iBamboo, an electricity-free and wire-free iPhone speaker made from a single piece of bamboo, whereby the natural resonance of the bamboo amplifies the sound produced by your iPhone. So bamboo seems so Asian. So let's first hunt for a few of these bamboo innovators in America itself. During the October 2007 peak to its bottom in March 2009, these American bamboos fell much less or even rise, and they went on to exceed the previous peak in 2007 by multiple folds, whereas we are only seeing the S&P break even very recently this year. There's, for instance, auto parts retailer O'Reilly with an 11 billion market cap, paints company Sherwin-Williams at US 16 billion market cap, trucking and freight company Old Dominion at 3 billion market cap, packaging company Rockten at 6 billion market cap, food technology company Belcam at 1.2 billion market cap. So these are not the typical innovative companies that we come across in our Harvard Business Reviews. And yet, they are very innovative because they have emptiness in their business model, much like the empty center in bamboo. I find that there are three sources of emptiness. One is the indestructible intangibles that stem from the know-how and having trust and support in the community. The second is having a core periphery network, which is about decentralizing and empowerment of the frontline people, scaling the business model by technology as an enabler, embedded into the business model design. The third is having open innovation in the business model, just like how Basedow and 3M are attracted to Baiyao to co-develop new products. So take the case of O'Reilly. To open an auto parts and repair shop requires no moat and has low barriers to entry, isn't it? So a capable owner might even scale up to 10 to 20 of such shops, earning a comfortable livelihood for himself and his family. As the number of shops increase, so too do the inventory, the type of products, the management issues, etc. To run a chain of thousands of shops takes a decentralized core periphery system. And leveraging upon the technology and 23 distribution center system at the core, the 4,000 periphery stores at O'Reilly keep few inventory. And this helps to tie up less working capital to enable O'Reilly with greater agility to respond to and focus on servicing the customer's needs, such as the fast availability of hard-to-find parts, which can be delivered fast from the core to capitalize on this long-tail demand. And O'Reilly manages 120,000 SKUs per distribution center, which is twice the industry average. And yet, they are able to increase far higher inventory turn while fulfilling customers' requests all the time. Because a primary factor for DIY and DIFM commercial customers is auto parts availability. If they can't find the parts at the store, they just find another shop to go repair their cars. So a primary factor, so each store inventory is also modeled to match the specific market demography. And O'Reilly and such bamboo innovators, they get stronger as they get bigger, eating up their smaller rivals and defragmenting the industry. So that is hardcore innovation built from emptiness. So like the bamboo, the nutrients and moisture that would have been exhausted making and maintaining the empty center can be utilized for the growth of other culms, the stems of the bamboo. From a builder's viewpoint, the architecture of the bamboo stem presents a powerful configuration. Fibers of the greatest strength occur in increasing concentration towards the periphery of the plant. And this core periphery network is also observed in the paints company Sherwin-Williams and the freight company Old Dominion to make them so resilient in market crisis. In Rock-Tenn, the packaging company, its intangible know-how in packaging manufacturing over decades is leveraged into developing the new lucrative business of in-store merchandising point of display, which is critical to its customer success, as we can see from the slide here. So the same goes for Belchem, whose intangible know-how in its micro-encapsulation protective coating technology is leveraged upon to control, protect, and deliver a wide range of ingredients in food, pharmaceutical, nutritional ingredients, and animal nutritional applications. So I cannot resist showing this slide from Sherwin-Williams, the paints company, just to illustrate the R criteria, the rootedness in its culture kindness. The store employees and the customers are loyal fans of their own company to the extent of tattooing their corporate logo on themselves. Sherwin-Williams is also one of the best employee of choice, with a culture that embraces talent at the front line and at all levels in the supply chain. And Asian culture will definitely be unkind to this image that is on this slide. Okay, you say, it's about using technology such as an effective ERP system or inventory system to scale up. So what's the big deal then? So I often hear very wealthy Asian entrepreneurs spitting the words, I can always make money first, invest in technology later. Ironically, it is the technology investments that tipped the once powerful Kmart into bankruptcy on January 2002, the classic case of a cheap cigar butt that gets cheaper. And the cigar butt has the halo of an extremely successful founder entrepreneur, S.S. Cresco, who was richer than JP Morgan at his very peak. Kmart spent $2 billion in 2000-2001 in IT and uses the same supplier as Walmart, which is IBM. The tangible assets and investments are there in the balance sheet and valuations are cheap. Yet, Kmart failed to replicate to compound value the way it did for Walmart. So why? The key is difference in discipline and integrating technology into the business model to achieve emptiness. Walmart is able to share its information with supplier in exchange for even greater discounts from its suppliers, to integrate with its EDLP, Everyday Low Price Business Strategy, while Kmart simply invests and collects data without a purpose. Walmart is able to scale in a tough retail industry by committed long-term investments in technology over the years. Walmart collects more data about consumers than anyone else in the private sector. They are able to mine this data into actionable business intelligence to ensure that consumers have the products they want, when they want them, and at the right price. For example, they have learned that before a hurricane, customers stock up on food items that do not require cooking or refrigeration, such as your strawberry tarts. So this is again how on the 50th anniversary of Walmart, they showed again their core strength is actually technology, powering Walmart to enable innovation for growth, for services, and for EDLC. Okay, you say again, and I often hear some wealthy entrepreneurs in Asia speak what emptiness is all about having resources, about having money, about having tangible assets that I can see and touch. Pour enough water, pour enough money, and behold, the powerful tree arise. So this 1968 photo, just to remind all of us, was taken when Burger Chef sold itself to the giant General Foods. Burger Chef is bigger than McDonald's with 1,200 stores versus McDonald's 970 stores back then. And it is opening at twice the rate of McDonald's. Yet, Burger Chef went bankrupt despite having the powerful backing and tangible resources of the giant General Foods. General Foods was a centralized empire. As Burger Chef SVP Robert Willman summed up on why they failed, they said General Foods was used to running a Jell-O factory, filling up boxes and building demand through advertising. We were in no position to duplicate McDonald's based off entrepreneurial operators. So just to emphasize, McDonald's emptiness is its trust and support in the community. And this emptiness is why bamboo innovators are often overlooked, perhaps even by the best investor Buffett himself. One of the greatest enigmas in value investing is why didn't Buffett make the Golden Arches a forever stock like Coca-Cola? And this is especially weird, isn't it, considering that Mac is the biggest customer of Coke too. In the early years, Ray Kroc had tried getting his rich retired golfing friends to invest as franchisees, but they failed. Only when Ray Kroc got hungry entrepreneurial operators did he succeed. But why did the best of three of these entrepreneurial operators chose McDonald's and not Burger Chef or Burger King's or Wendy's? So this is again to show that American bamboo innovators like McDonald's are resilient in crisis during the 07-09 global financial crisis, where McDonald's didn't fall much and then it went on to exceed the previous peak by multiple folds. And this emptiness in trust and support from community of customers, suppliers, and partners is key to why McDonald's is able to compound value over the years. As Ray Kroc said himself, I know we have the only clean, honest franchise. McDonald's has no kickbacks, no upfront fees in the initial years, sacrificing quick franchising profits as it truly cares about the subsequent performance of the operators. It also has a culture and system that cultivates and acts upon the ideas from the periphery. Big Mac, apple pie, Filet-O-Fish, McNuggets, they were all ideas from the franchisee, the independent operators that form 3/4 of its fast food restaurant business empire. Interestingly, flops such as pizza and pasta were all ideas introduced from the central headquarters. So how about Asia, Japan? Isn't Japan so yesterday when Korea's Samsung is now twice the combined market cap of Japan's once mighty Big Five, Sony, Panasonic, Fujitsu, Sharp, and NEC. Trade and current account deficit in Japan is also at all-time high due to exports that are structurally uncompetitive. Are there Japanese bamboo innovators despite such a poor macroeconomic scenario? Do keep in mind this chart here that the strong yen period from 1968 to 2000, when yen appreciated from 350 to 100 compared to the US dollar. It is supposed to spell the death of exports in Japan, or a phenomenon they call Endaka Fukyo. Before we proceed further, take a look at this slide, Nidec versus Keyence. Nidec has a dominant 80% global market share in hard disk drive spindle motors and other miniaturized motor products, and an army of 100,000 employees. Keyence, in contrast, has only 3,000 employees and less than 1% global market share in what is known as a commodity-like laser sensor products for factory automation. So the natural question I'd like to pose to all of us is, which CEO do you wish to be? Both Keyence and Nidec are great companies forged from the strong yen period, when yen appreciated from 350 to 100. Interestingly, Keyence, with 3,000 employees and an insignificant global market share in its commodity-like product, has a market cap of 17 billion US dollar, which is double that of Nidec, which has 100,000 employees. And Nidec used to be as big or even bigger than Keyence in terms of market cap, and now Keyence is double that of Nidec. So what is Keyence's success criteria? Keyence is able to turn laser sensor products, a commodity product, into high-end services and solutions because it cultivates emptiness in decentralization and empowerment. The founder, Takizaki-san, understood keenly that Keyence cannot improve on Japan's legendary manufacturing efficiency. So unlike its manufacturing-based competitors, which focus on manufacturing and lift sales to distributors, wholesalers, and agents, it deliberately avoids making products except for manufacturing steps that involve trade secrets which are kept in-house. Most of its 3,000 employees are either sales or research staff. In their direct contact with the customers, Keyence's in-house sales team pick up new product ideas on frequent factory visits. For instance, Keyence's frontliners observed from the production lines at instant noodle factories that the noodle quality was compromised because they were manufactured at variable thickness. So laser sensors that could measure noodles up to 1 to 100th of a millimeter were developed and used by giants such as Nissin, the inventor of instant noodle, to keep noodle thickness consistent so that when you eat it, it's tasty. And 25% of sales at Keyence are generated from such new products annually, and this is even higher than 3M's 15%. Emptiness can come also in the form of trust and support and community, and this has resulted in Japan's Priceline, Kakaku.com, and M3 to be resilient compounders in crisis. So Kakaku is 2.2 billion US dollar in market cap. This is M3, which has a 2.8 billion US market cap. So we can see from both charts in their price performance, they were resilient during the crisis. So Kakaku.com was started in 1997 by Mitsuaki Makino as a website which lists the retail price of Akihabara, which is the Japanese electronics market in Japan, Tokyo. Building upon its intangible quality, its trustworthiness and reliability amongst the Japanese community of consumers, wholesalers and retailers as an informative site which shows the best deals all the time of electrical products, Kakaku.com is able to grow into new areas such as insurance, forex currency trade, and finance site, restaurant ranking gourmet site, Tadlog, which is like Zagat in America, word-of-mouth travel site for travel, last-minute hotel reservation site, yoyaku.com, real estate and housing information site, Sumanti, and Mention DB, and so on. And the same goes for M3, which is also in America. M3 started out with its core MR Kun service, which is like a Google for medical professionals, used as a marketing e-detailing tool by pharmaceutical giants to provide consistent repeated delivery of information on products and diseases. A dominant platform in Japan used by 80% of its physicians, MR Krun is rated by over 92% of its users who said its usage deepened their knowledge of diseases. With this intangible trust built up amongst the community of its users, M3 is able to leverage this relationship with its members to develop new online tools. This includes online tools and clinical trials to determine the feasibility of trials and help with patient recruitment, market research and survey panels, and online job search and career information site for member doctors and pharmacists, which is like a LinkedIn.com if you might think of. M3 even expanded from B2B to B2C by providing a range of services for consumers, including AskDoctors.jp, a subscription service that gives patients a chance to ask doctor questions about their ailments, and iTicket, whose more than 500,000 members use the service to make reservations at clinics, especially amongst anxious mothers for their kids. Mayonnaise and drugs cannot be more different, but Kewpie, which is the mayonnaise king and Heinz of Japan, has also leveraged upon its emptiness in deep intangible know-how about eggs, the main ingredients of mayonnaise, from handling over 10% or 250,000 tons of eggs in Japan over the past 2 decades, to pursue the full use of eggs to expand into new product categories and new customer segments. So this is Kewpie, the Heinz of Japan. So from these examples, there is one favorite due diligence question that I often like to ask when I see Asian entrepreneurs and managers. Most Asian companies are one-man shop operations with the founder making all the decisions. The willingness to build a culture of decentralization, empowerment, and invest in a system to cascade decision rights throughout the organization is a very important signal for value investors that the founder desires and cares to scale up the company in a sustainable manner by not hoarding knowledge and information. And technology is an important tool in empowering their employees and in giving them an information advantage in their respective roles and responsibilities at work. So this is just to sum up the Bamboo Innovator Framework quickly, where emptiness is the mother of all things. So does the company have indestructible intangibles? And this can come in 2 forms. One, the know-how, which is like Yunnan Baiyao, with its deep knowledge in hemostasis on blood circulation and blood clotting, to even leverage this to go into toothpaste. Or 2, the trust and support in community, just like McDonald's, Kakaku.com, M3. Secondly, you need to ask in emptiness whether the company has a core periphery business model. And this again comes in 2 forms, decentralization and empowerment, as well as technology to scale up the business, just like O'Reilly, which uses a sophisticated technology system at its core to help the periphery 4,000 over stores to be asset light, to know which are the hard to find parts, to quickly service the customer's needs. And 3, you need to observe as value investors whether the company has an open innovation business model. In a way, it's just like the Baiyao example again earlier, how famous companies and MNCs like America's 3M and Germany's Beiersdorf, these giants are attracted by Baiyao's emptiness to pursue and co-develop new products together with them. So the next part of my presentation is hopefully to highlight to investors that there are a lot of booby traps in this capital jungle, because Asia is not a monolithic block and can be a landmass for value investors without a resilient mental model. Asia is really heterogeneous with geographical differences between countries and within itself amongst the different provinces. Unlike America, which is more homogeneous and more scalable for businesses as a result, which is what Coke said in its early days as well. Another observation is that many companies are still stuck in stage 1 of their corporate cycle. Presently in Asia, the median listed company size is around 40 to 80 million US, and a significant number, or more than 80% of companies are below the billion-dollar mark in market capitalization. So this is the firm-level situation in the macro backdrop of Asia's balance sheet become increasingly bloated with debt, as you can see from that Wall Street Journal chart in the slide. So we will explore what this means for value investors in Asia. The easy low-hanging fruit of investing on the basis of macro themes in Asia is gone. As Asia's capital markets develop and mature, clients need to be very, very suspicious of the old workhorse argument that, oh, Asia is growing and a rising tide lifts all boats. Means the bullish growth prospects and you regret. Asia is underallocated on a GDP-weighted basis, and you should position your portfolio early in the rebalancing process. So this workhorse argument is largely true during the decade from 1998 to 2008. But the 07-08 global financial crisis is a game changer at the micro or firm level as the capital markets in Asia deepen, develop, and mature. Firm-specific strengths and weaknesses are attenuated in their growth expansion strategies and business model scalability. So because of the geographical differences that impose limitations on the scaling up of business models in Asia, the next decade in Asia to 2020 for value investors will really be the revenge of the geographical investor, borrowing the theme shamelessly from Stratfor's chief geopolitical analyst Robert Kaplan's book. Business models, in my view, need emptiness all the more to scale up in Asia and globally. So let's take a look quickly at one quirky aspect of geography in Asia, in India in particular. So why does India have so few listed internet companies compared to China? To borrow from the wisdom of Lee Kuan Yew, the founder of modern Singapore, India's linguistic differences between its various geographic regions has been a constraint to internet development. India is often described as a country where the Sanskrit tongue is chilled to silence at 500 meters. Most phones sold in India come with English language operating software. So despite India's reputation as an Anglophile nation, only a tenth of its 1.2 billion people count English as their first, second, or even third language. A few phone makers, notably Nokia, have tried adding Hindi, India's most widely used language, to their operating systems and physical keypads. It didn't catch on, in large parts because with 3 dozen consonants, 10 vowels, assorted symbols, and innumerable combinations, Hindi is not very user-friendly on just 12 keys. In India, just mention the word Parsi, and you will be perceived as an expert value investor. The Parsis are a small group of Indians who have a disproportionate influence in business compared to their tiny population concentrated in Mumbai. From the Tata to Godrej, Parsi bamboo innovators are resilient compounders. We can see here from the chart there's Tata Global Beverages, 1.4 billion US market cap, Titan, which is part of the Tata Empire, 4.1 billion US market cap, and of course the flagship Tata Consultancy Services, 56.8 billion US market cap, and Godrej, in the picture is Adi Godrej, 4.7 billion market cap. And in India, they have their very own America's paints company, Sherwin-Williams, called Asian Paints, which again you can see is a resilient compounder in crisis. When the Sensex index plunged more than 60% from 07 to 09, Asian Paints, in fact, didn't fall much, and it has exceeded its previous peak by over 280%, with a market cap now of 7.5 billion market cap. So Sherwin-Williams, which is the Indian version Asian Paints, is able to scale up by sophisticated use of technology to innovate in a traditional fragmented industry as well. So now comes the fun part about Asia, the scary pitfalls. So Chinovation is not equals to resilient compounders. Take Suntech, which is formerly the world's largest solar panel manufacturer. So all the Guanxi relationship and support from the government, all the tangible resources and help. And the founder was formerly China's richest man, according to Forbes, but bankruptcy was his fate. As you can see here again, it was a compounder only for a short brief period from 05 to 07, and then it starts to crash, as I have mentioned at the very start, whereby accounting scandals starts to unravel post-financial crisis, which is a game changer at the firm level. So we cannot use the same old lens as before to look at stocks in Asia. So contrast Suntech to Tencent, listed in Hong Kong, which scaled 65 times from US 900 million market cap from its June 2004 IPO to its present US 65 billion market cap, bigger than Facebook. So Tencent has no tangible resources in its early years. In fact, Tencent's founder, Pony Ma, ripped off the instant messaging services QQ off Israel's ICQ in 2000 as a free online download. And after burning US $1.1 million, the two investors that Pony Ma found, they were so anxious to sell their shares because it's burning cash every day. The company was shopped around for nearly any price, free even, to China's largest portals. But no one, absolutely no one, wanted to waste money on a company doing instant messaging. After all, they thought, if the mighty American AOL couldn't make money off instant messaging, who else on earth could? So its tipping point came when Tencent offered virtual goods. Avatars, outfits, pets, and emperor kids in China spent pennies and hours collecting. Tencent monetized instant messaging when Western giants failed and built chat not only as a productivity tool, but more so as a community for bored kids to hang out. Many have tried to copy Tencent, but failed because they didn't cultivate the emptiness in know-how and trust and support from the community of bored kids. Kingdee, once the ERP software king for SMEs in China, or the SAP of China, an aircraft carrier in the software industry, it emerged from the Lehman crisis to compound value until 2011, when it was disrupted by SAP Business One, a locally developed ERP software targeted at the core SME customer base. So this is the SAP Business One developed by the German giant. So this has disrupted massively companies like Kingdee, which were once powerful and successful. Li-Ning, the Nike of China. When the Li brothers went into property development in a high-profile way, the core business was neglected, and Nike, which has been active in the Chinese market for 30 years, ventures beyond the Tier 1 and Tier 2 coastal cities into the domestic brand strongholds in inner China, and Chinese consumers increasingly lose the taste for domestic brands and quality counterfeits, while Nike continues its well-crafted marketing campaigns in introducing more lower-end products and cultivating its brand cachet at the top end. Shares of the once multi-bagger domestic brands like Li-Ning were down 50 to 80% from their 2010 peak. Nike shares, in contrast, hit an all-time high. Oh, some of the value investor might say, when the property development news came out, oh, this is all expected by the market, so we should bargain hunt. We should pick a cheap stock because it's getting cheaper. It was $24, now it's down 20% to $19. Buy, buy, buy. And then again, it's down another 20% to $15. So value stock getting cheaper. Buy, buy, buy. And then again, it's down another 20% to $12. Yet again, the call by value investors using quant screens, buy, 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 and so on. And the value investor buys into the stock until below $5 now. So do we invest in Asian fallen angels whose valuations are tempting and alluring from a quant perspective? Are they cigar butt traps like Kmart? So Asia is now at a critical transition point. So Kingdee the ERP software company, and Li-Ning, the sports retailer. They are typical Asian companies with one successful halo. Many once successful Asian businesses have lost focus during the property boom post-financial crisis. Many successful and wealthy Asian business owners like to point out to me in a well-meaning way that those who have used the company's reserves and profits to invest in property during the recent financial crisis have come out on top of those who stick closely to their knittings in their core businesses. So what they do not know is that bleeding quietly in their initial years operating in China, the intense focus at several of these MNCs like Nike and SAP, they have hit the tipping point in scaling up their own operations, helped in no small part by the distraction of local entrepreneurs in the property and speculative activities, neglecting their core businesses. So value investors in Asia cannot look purely at quant valuation metrics, since many business models are permanently impaired or they are K-mut. Once successful stage 1 entrepreneurs have scaled their companies by multiple folds to say under $1 billion in market cap in the past decade. But as a result of them mishandling risk or preventing them in the first place through business model design, these companies fail to make the successful transition from $1 billion to $10 billion in market value, and they are now stuck. So the investment analysis and valuation impact of the multi-horse, the business model, matters more than the jockey, the entrepreneur, in this transition period, which Asia is currently in. So at this transition point in Asia, besides a group of entrepreneurs and managers who are still trying very hard but pushing the same, possibly inappropriate levers for growth, there's another conspicuous group, particularly in the below billion-dollar camp. These are people who find themselves stuck in stage 1. They grow to either become disillusioned with their core businesses or contented with what they have achieved. Often, these successful achievement-oriented entrepreneurs starts to stray as they find it easier to seek growth by engaging in private business interests outside of their listed vehicles, particularly in property development. A rising tide no longer lifts all boats like it used to in the past decade in Asia. Investing in the easy pickings of low-hanging fruits in firms with a sexy Asian growth story works greatly during the 1998 to 2008 decade. But the great financial crisis has shaken out the imposters, the disillusioned, the contented, the distracted, and value investors and clients have to be very, very careful of entrepreneurs and fund managers who continue selling the snake oil of buy Asia's growth, Asia's is rising. For at the firm level, it's a very different story. As we can see from the case of Li-Ning, which is supposedly riding on the domestic consumption rebalancing in China. So value investors in Asia have to be careful because many business models and modes are permanently impaired. These Kmart stocks are likely to trade at plus minus 20 to 50% return band in the next 5 years. And these stocks are the fertile ground for momentum traders and nefarious insiders called zhuangjia in Chinese, who have the incentive and power to manipulate prices and volumes and to inject action via announcement of sexy projects, M&A, share placements, luring greedy investors in and then offloading to them in a pump and dump Sisyphus cycle. So this slide is the China's original GE and the original Enron. It's called Xinjiang Delong. It compounded value by more than 20 times during 1997 to 2004. 20 times. It has good assets, such as the Xinjiang tomato processing. So did you know that Xinjiang is one of the largest tomato processing area in the world? But yet it collapsed. And when it collapsed, China's financial system shakes with 100 billion in hidden debt. So the key question is, should we be bold and contrarian and buy when there's panic and fear? Buy when there's a 20, 30%, 50% price drop in supposedly once good companies in Asia? Can we use this framework to invest in Asia? So this is akin to discovering some hair or finger when a brick in the wall falls off and dismissing it and not examining it further when bodies are disposed of behind the brick wall. Because the key is that murder, which is earnings management and real activity management, is easy. But it is the disposal of the body that's difficult. So the incentive part, this earnings management, real activity management, is easy. But the opportunity in disposal, the selling of shares by manipulators, the expropriation of cash and assets by insiders, that's a little bit more difficult. So some of you might be thinking, let's be momentum investors. Let's queue first. Let's do the murder. Right along with the murderers for the momentum and insider gains. And then think about disposal later. For we can always exit faster than the rest of the public market before the crash. Just like Xinjiang Delong, right the 20 times. So sometimes and oftentimes, the entrepreneurs get demotivated after seeing the share price of their companies crash. And they simply give up on building their companies because they have so many other options in their private business interests. And they start to expropriate cash and assets out of the listed vehicles, the very ones that you invest in because they are cheap on a quant basis. So value investors in Asia need an IO, Incentive Opportunity Accounting Framework, which I'll explain very shortly. But first, let's look at Walmart, which is up 1,000 times since its 1972 IPO, but it was down, not many people know, by more than 60% in its first 3 years. 60% down. The stock can bounce back still, primarily because Sam Walton has one key business vehicle, which is Walmart. In Asia, the entrepreneurs have multiple vehicles in their private pockets. So they can always abandon the listed vehicle that you invest in. So this Mungarian IO framework, I stands for the incentive to expropriate, the Y, because it is easy in Asia, whether you have Big Four auditors or not, whether you have good regulators like in Singapore or not, because of the big wedge, which I'll explain very shortly. O stands for opportunity to expropriate, the how, which is via related party transactions or RPTs, asset transfer injection, laddering in IPO exploration, delisting, etc. So this is Accounting 101, or more appropriately, Accounting 102, which requires due diligence. One cannot be lazy with quant screens and simply make tire-kicking due diligence trips to say one has done the work in Asia. Because after all, as fund managers, we all know that when we go on due diligence trips, the companies will always bring us on good dinners to see the good parts of the plants, etc. So these are the 3 steps to how set-up companies use to expropriate assets. Step 1, enticement and earnings management. Step 2, exercise not, no skin in the game. Step 3, expropriate. So take India Satyam, US 1 billion net cash in the balance sheet, value stock. But yet all the cash was missing. It's all about the wedge, or the difference between cash flow rights and controlling rights that incentivize the owners to treat the business as their own empire. And minority shareholders are dumb fools who deserve to be trampled upon. Even though Satyam's Ramalingam Raju had 8 to 9% cash flow rights to the listed company, he has high control rights as the founder and CEO to override governance system, to simply expropriate assets out of Satyam to his private property companies, primarily Maytas, M-A-Y-T-A-S, the opposite of Satyam, in which he has 100% cash flow rights. So, as Jim Rogers say, India is an astonishing country to visit, but as a place to invest, it's a nightmare. Jim Rogers is right. So in this slide, always watch out for complex ownership structures in Asia, as it is how entrepreneurs gain control rights despite having low cash flow rights. Without knowing the wedge in Asia, all your quant screens and numbers and contrarian wisdom of buying on panic is useless. So take the old examples of Eganna and PaySmart, which are listed on Hong Kong Stock Exchange. Durable consumer franchise and value stocks with plenty of net cash in the balance sheet. So they are delicious compounders until the accounting unraveling and the first blood was drawn with price plunge of 20 to 30%, and value investors scream, buy, 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 cheap value until they bleed to death. So in the case of Eganna, the cash are promissory notes from related companies, and the related receivables are converted to goodwill after acquisitions funded by capital raising from investors, bringing them in a money-go-round transactions. For PaySmart, the cash and assets are turned out of the listed company via deposits or loans to related business associates. So these are all seemingly very good consumer companies where the brands are visible, very visible. So slide 63, you can see, always know your RPT, your related party transactions in Asia. They are not found in quant screens. There was this conference that I went to, and one of the speakers was from Norges Bank, the Norwegian Sovereign Wealth Fund. He said that after investing in Asia for quite a while, and having some bumps and losses along the way, they also realized that RPT, related party transactions, was a key governance criteria to protecting the downside of their massive investments in Asia. So accounting 101 check. Value investors should at least not be lazy and check the ORECTA, or net other receivables, as a percentage of total assets. Companies with high ORECTA have a higher probability of expropriating assets from the listed company by the controlling shareholder. So this is the O in Mangarian IO framework, the opportunity in disposing the dead body. A hardworking detective can find out what's wrong. Behind the accounting, there are always 3 steps. Step 1, book artificial sales. You debit other receivables, credit sales, and the sales are artificial. Step 2, you beat the drum. Earnings management, raise capital, sexy growth story, M&As, etc. Step 3, you cancel out the receivables that were used to make the artificial sales earlier. So it's debit goodwill, credit other receivables. And this goodwill comes from the M&A activities that goes into the intangible in the balance sheet. So for those who like empirical analysis, you can try regressing future abnormal stock returns as your Y on the left-hand side and ORECTA as your X on the right-hand side. So again, these are empirical research looking at propping and tunneling, particularly relevant in Asia, as the governance risk in Asia is different from the West, as Asian companies usually have dominant controlling shareholders, unlike the dispersed share ownership in America. So the controlling shareholders are smarter than you think, as they understand the need to balance propping and tunneling. So for instance, if the oil and gas sector is hot at the moment, garnering high PE ratios, they will search amongst their business units and prop up and boost the oil and gas earnings from assets tunneled out from their other business units. So they will start to raise capital via the hot sector momentum and then use the money raised to plug holes in other units in his or her empire. But they probably outsmart themselves in the end, as we will see at the end of this presentation. So again, this is another empirical analysis. And I was taught by Prof. Aharoni, who did up this research that you see in the slide here. So our markets dumb and cannot predict events. So this is an empirical analysis of the Hong Kong Stock Exchange announcements of related party transactions. So this is a descriptive table detailing cases of tunneling and expropriation during the 1997 to 98 Asian financial crisis, including our beloved Samsung, who was tunneling assets to support Samsung Motor, which eventually failed. So Lee Kuan Yew, the founding Prime Minister of modern Singapore, has this to say about business in Singapore. So set up a restaurant, and that's considered business to Singaporeans. So his wife's words also implied that there is a stark difference between business and business model. And I'll explain very shortly. To see the difference between business model and business, take the case of Hong Kong listed Fuji Food and Catering. So as we all know, restaurants are slow in the sense that they have high fixed costs and capex, so they are slow to break even. So most would think, let's have a franchise to lighten things up. So Wei Tong, the founder of Fuji Restaurant, decided differently. He decided to load up fixed costs aggressively. So it's very contrarian, right? So the business model is a caterer for millions of factories in China. And these factories are locked into long-term contracts, which Wei Tong can use for planning and budgeting purpose and to raise capital from banks and investors. So it was listed on Hong Kong Stock Exchange on December 2004, and Wei Tong became one of the richest men on Forbes China's list. And Fuji was even an exclusive Beijing Olympics 2008 caterer with more than US $2 billion in market cap. A darling stock, a compounder, but it's not resilient, and it went bankrupt. So we all know what we what we go on, the due diligence trips to kick the tires, because as I mentioned earlier, the management always show us the good stuff. They bring us on good lunches, good dinners, etc. So when visiting Fuji, after seeing all the modern machines busy chopping the meat and vegetables and stamping the Fuji brand on the lunch boxes, so I simply said, "Excuse me, where's the toilet?" And I went to explore the place on my own. And I came across a big area. So some of you might jump the gun here and say, the machines, the expensive machines, they are all idle. There's no activity. Nope, you got it wrong. The machines are great and they are very busy. But they are busy chopping the food for pig farmers and other restaurants. So these are ad hoc revenue without brand or pricing power. And the sales are booked under the overall revenue figure. The expenses are capitalized under the capex figure in the cash flow statement, boosting artificially the profit margins. It is easy to do these accounting tricks because they are expanding fast, and the capex figure in building the processing plants with all the modern equipment across the different regions of China. This capex figure is so huge enough to make it easy to lump up the operating expenses. And when the stock is doing well, no one asks questions, right? So fast growth and high capex can be dangerous. What looks like a value stock with high profit margins, fast sales growth, solvent and healthy balance sheet, they are all a mirage. As we can see here from the South China Morning Post, in the post-mortem analysis when it went bankrupt, it says, oh gosh, it is a company that looks so healthy and solvent with all the cash and assets that satisfy all the value stock criteria from the quant screens. So you might say in a skeptical way, so all these catering business models cannot be compounders in the first place. So remember, Walmart is up 1,000 times. So catering business model Cisco, listed in America, is up 4,000 times since listing in 1978 to 18 billion now. So in 1995, when Cisco was around US 2 to 3 billion, or Fuji peak value, Cisco invested in technology to scale up. For instance, it uses technology to understand the profile of customer base in different places, such as the Hispanic and ethnic population is bigger in, say, El Paso, Texas, and then they are able to cater the taste of the food accordingly. So Australian listed ABC Learning, formerly the world's largest listed kindergarten center, is another example of accounting capex fraud. Basically what it does is it'll do a lot of M&As of underperforming kindergarten centers, bring them into the ABC umbrella brand, and boom, Fast Eddie says the profits will turn around from economies of scale in a network effect way, and voila, you get your investments multiply many times. So he knows the sexy words to say to investors and bankers. He's really good. So billions of dollars from bankers and investors go to paying developers, which are largely related party to Eddie Gross, for questionable contracts in designing, in developing, and in refurbishing the kindergarten centers that they acquire, and to fund the M&As. So the developers that are related to Eddie Gross and his uncle, they are used to pay back, they pay back and in a quiet way all the funds raised to ABC to boost their revenue and profits during closing end of the financial year, and to help them to achieve their budgeted numbers. So the revenues were reported net of the expenses under the old accounting rules. There was no segmental breakdown of the revenue. So when I met with Fast Eddie Gross, when he was at his peak as a billionaire in fourth quarter of 2007, I asked him this trick question. So Eddie, half of your 1,000 kindergarten centers are making money, mainly from government subsidies? No, 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 the billionaire replied. He said, only about a third. So this is a classic Freudian slip. You smoke 5 packets of cigarettes a day? Oh, no, 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 only 3 packets. So we know that he's a smoker, right? So later, when ABC Learning declared bankruptcy and post-mortem auditing was done, it was found that around 35% of the centers are not breaking even. So Eddie's Freudian slip to me was quite accurate. But I wouldn't recommend to try this because we have to be sincere, yet skeptical at the same time. So we have to do a lot of background homework before we attempt this. Hopefully not. So skillful fundamental analysis is to combine different contextual information, not just blindly look at quant screens. So this is my empirical research which I published in the Istanbul Stock Exchange 25th anniversary special paper competition in a peer-reviewed journal. Basically, governance and accounting quality are like the bow and arrow. Without governance as the bow, having accounting quality doesn't allow you to shoot for returns accurately and far. And without the arrow of accounting quality, the bow of good governance is not useful. So for instance, if you look at the future returns from firms with good governance, they are significantly positive. But if we take out from within this good governance group companies with good accounting quality, the returns becomes almost zero. So it means that good governance no longer pays off. So for more information, you might want to just download my paper. So the summary of what we have covered so far under this topic of Asian booby traps is that 1, beware that chips gets cheaper, like the pigs, which grow more valuable by about ½ kilogram per day. So even mega steel makers in China invest in pig farms. Well, it's fashionable, isn't it? So until we see pig carcasses floating around the river. So beware of value traps in Asia. Do not be seduced by the quant screens alone. So number 2, Walmart is able to bounce back after plunging more than 60% after its 1972 IPO when it was a small cap, because Sam Walton has only one key business vehicle. But Asian entrepreneurs, they have multiple business interests in their private pockets, so they can always easily abandon the listed vehicle, the very one that you will invest in, the very one that when the stock price plunged 20%, 30%, 50%, and calls for buy, it's an illusion, you know. Behind the facade of the beautiful shop front and the robust balance sheet assets are related party transactions. The RPTs that Norges Bank also found out that it's so useful to watch out for in terms of the expropriation assets by the controlling share owners. So value investors, we must always check our accounting 101. So this ends the Bamboo Innovator framework that's overlaid in this Asian capital jungle, which is full of booby traps. And in the live seminar on April 10th of the Emerging Value Summit 2013, I'll be sharing with everyone an actionable Asian stock idea that I wish to discuss that falls under this Bamboo Innovator framework. So I'm excited to join you on April of 10. Thank you very much.